Thanks for joining David, Kevin, and myself for the educational video for the month of August. Today we're going to talk about a crucial subject, market volatility, and how important it is to get control of your emotions and not allow them to have you do things that you probably shouldn't do. David and Kevin are going to do a deeper dive into a lot of these different topics, but as always, if you have any questions, want to review anything, please don't hesitate to reach out to any of us, and I'm going to pass you over to the guys. Take care.
Market volatility refers to the ups and downs that investment markets go through throughout their regular cycle. And when markets are more volatile, these ups and downs are felt a bit more significantly than in other times. But it's important to know that market volatility is an extremely regular occurrence within markets and is nothing to be concerned about over long periods of time. As recently as a couple of weeks ago, we witnessed a significant amount of volatility. Over the 4-day period of July 31st to August 5th, the S&P 500 dropped over 7%.
The reasons for that volatility was twofold. Primarily, we saw a carry trade being unwound. And a carry trade refers to the idea of borrowing money in one currency, a low-yielding currency, and reinvesting that money into a higher-yielding currency. And this had been a popular trade for well over the past year, as investors were borrowing money in Japanese yen at close to 0% and reinvesting it in other higher yielding currencies like the US dollar. Now, in early August, the Japanese central bank actually surprised markets and hiked interest rates by 0.25%, which caused the yen to surge by 8% versus the US dollar. And in that backdrop, a lot of people who had these carry trades on, like hedge funds or quantitative funds, they were forced to unwind their positions in quick order. And so we saw the market sell off. Now, after that happened, we also had US jobs release data regarding unemployment, and unemployment was much higher for the last month than was forecasted. So you had this sort of double whammy on and around August 5th. And between July 31st and August 5th, the S&P 500 dropped nearly 7%. And then, if we fast forward to today, we're filming this on August 20th, we look at the S&P 500 performance from the end of July to now. We saw a 7% drop around that sort of flash crash early in the month, and now it's recouped all of those losses and some at this point in time. So that's just the most recent example of some fairly sizable volatility occurring. But, for any investors who maybe ran for the hills during that point in time, and they're still sitting in cash, and the market's now recouped 7% of those 7% losses, I'm sure those people may be kicking themselves. And so this is just the most recent example of how not to behave and how to behave when the markets are facing some short-term volatility.
And market fluctuations, as David mentioned, can be caused by a number of reasons, from market sentiment, geopolitical data, economic data. All these can cause different forms of market fluctuation, and although unsettling, it's important to be reassured that this is completely normal within investment markets. Let's take a look at some historical data. Despite short-term volatility, the stock market has shown a consistent upward trend over the long term. The S&P 500 has averaged an annual rate of return of about 10% since its inception. This demonstrates the resilience and growth potential of the market over long periods of time. Investing during volatile times can be challenging and can cause people to make some short-term mistakes that could affect the long-term growth potential of their investments. Let's take a look at what some of those mistakes look like. We have panic selling, going to cash and staying there, over-trading on the account, ignoring diversification, letting your emotions drive decision-making, not rebalancing your portfolio, and chasing short-term performance at the expense of your long-term goals. Avoiding these common mistakes can help you better navigate investment volatility and stay on track to meet your financial goals.
Managing your emotions during downturns in the markets we know can be challenging, but it's critical to becoming a successful investor. Here are some strategies that you can implement to help yourself manage your emotions during these difficult times. Sticking to your financial plan, focusing on your long-term goals, limiting your media consumption when volatility is high, ensuring your portfolio is well diversified. You can even practice mindful and relaxing techniques, And you should seek out the advice of your financial planner. That's what we're here for. Avoid overtrading your account and stay educated by asking us questions about what's going on in the markets.
So why is it important to stay invested during periods of volatility? Here's a couple of key reasons why. First, time in the market beats timing the market. Trying to predict market movements and make short-term trades can be risky and often leads to missed opportunities. Staying invested allows you to benefit from the market's long-term growth. Second is compound interest. The longer you stay invested, the more your investments can grow through the power of compounding. Reinvesting dividends and capital gains can significantly boost your returns over time. And third is diversification. By spreading the investments across different asset classes, sectors, and geographies, you can reduce risk and smooth out the impact of volatility on your portfolio.
In conclusion, market volatility is a normal part of investing, and it's something that every investor should expect at some point. Now, there's many different strategies that we've talked about today to help you deal with volatility, and you may find that some work for you and some don't. In the past, I've had clients tell me that in 2008, during the last financial crisis, some of them didn't even open their investment statements for more than a year because they knew that if they did, they'd be tempted to make an emotional decision. Whereas other investors might want to know exactly what's going on in their portfolio and exactly what's going on in the markets. And knowing that may arm them with the knowledge that they should stay invested. No matter what strategy might work for you, we're here to help you develop those strategies, and we're here to help you stay invested. At the end of the day, we know through history, overtrading your account, going to cash, all those sort of things that you might be tempted into doing when there's market volatility usually don't work out in the long run. Typically, all of our clients who have stayed invested have been rewarded handsomely over years and decades of investing.
But as always, if you do have any questions about your account, your portfolio, or just the markets in general, Harry, David, and myself are here to take your call.